Welcome to today's podcast, hosted by Fagry Baker Daniels. Opinions expressed on this podcast do not necessarily reflect the views of the firm or of the American Insurance Association. I'm Scott Kosnoff, your host, and today we're here with Leigh Pusey, President and CEO of the American Insurance Association. Leigh, thanks for stopping by.
Thanks for having me.
We have a lot of ground to cover today, but why don't we go ahead and start with the covered agreement? You've come out in favor of the agreement. Let's talk about why.
Well, I think the simple answer is the covered agreement solves the problem. I think most people have thought about the covered agreement inside the four corners of reinsurance collateral. It's an issue that had been out there for decades. Tension between the European Union and the U.S. over how we dealt with collateral. It was seen as a trade barrier, if you will. The U.S. had a position until 5 years ago of 100% collateral from foreign reinsurers. And it was only at that time that the NAIC then embarked on a modification through a model law, as we all know, that scales that according to the creditworthiness of the reinsurer and other factors that are important. But until that point, we had a 100% rule here, and now it is now still pegged to some credit rating. The Europeans would like to see it zero. Now, they're not pure either, and they're imposing collateral in jurisdictions within the European Union. And that was beginning to intensify, quite frankly, as the U.S. was taking more and more time to adopt this model law. But that was part of the original focus. So in Dodd-Frank in 2010, after the financial crisis, there was a legislative resolution to deal with the problems created in the financial crisis. And Title V was an insurance title of that law. We've all spent a lot of time in this industry, in the broader financial world, talking about Dodd-Frank since the crisis. But Title V was unique for insurance. And among the many things it did, it created this Federal Insurance Office. And while it definitely limited its authority, and in fact expressly says it's not a regulator, it did empower this office, working with USTR, to do what state regulation can't do, and that is engage internationally and bind the U.S. in regulatory prudential matter type agreements. Hence a covered agreement. It's a new vehicle, new to us, hadn't been used before. And in that very law, it really was envisioned to deal with an issue like collateral. And so as we embarked on the final days of the Obama administration and efforts that had been underway in the last 2 years to move towards a covered agreement, it was really seen through the prism of how this was going to resolve some issues in the reinsurance space. But no one was paying attention to the impact in the primary insurer space. We have companies like household name companies like the Travelers companies or the W.R. Berkley companies, who are U.S. companies, domiciled in the U.S., holding company in the U.S., but have operations in the EU, and in particular case for this example would be also in the United Kingdom, in London. And the Prudential Regulatory Authority in London about a year or so ago approached these companies and said, you know, we're getting ready to implement Solvency II. It's going to go online in January of 2016 in Europe, throughout Europe. And that requires us to look at other jurisdictions doing business in the EU and judge whether you're equivalent or not. Your regulatory regime is equivalent to ours. The U.S. is not in areas like group supervision, in areas like group capital, and other areas. And therefore, we're having trouble here because we're going to have to require you to do some things, onerous activities. You're going to have to report consistent with EU Solvency II. You're going to have to hold capital consistent with EU Solvency II. We're going to look at corporate governance as we do it here in the EU, and in essence, upstreaming to your holding company in the U.S. requirements that we have here in the EU. Companies began, obviously we're very concerned about that.
Sure.
And so there was an approach to Congress here, which was limited. It couldn't do much, but it could hear us out. And we went to the Treasury Department and raised this concern and posited maybe the covered agreement could also be a vehicle to try to resolve this discrimination that was also happening to U.S. companies doing business in Europe. Now, I should say that those companies were given letters of agreement from the PRA to operate over the past year while this agreement was being negotiated, basically in anticipation of some favorable resolution of the agreement. So, but the problem exists. So as the Treasury Department and USTR were negotiating this, we brought the concerns of the primary side to the table as well. And I think that's where we saw this agreement broaden out a bit to recognize group supervision and group capital. In essence, get something for resolving the collateral issue. And that also solved a real problem for primary companies, U.S. companies, doing business in Europe.
So when you look at the finished product and you look at it through the lens of the insurers, what do you think the agreement means for them?
Well, I think in the short run, it means that the European Union and those 26 jurisdictions will look at U.S. companies and have to acknowledge that our state-based system, and it's a little awkward, but we get to a form of group regulation, works for them. They, in other words, can't force their system on us. They have to recognize is the word that's used here. Mm-hmm. It's not equivalent. It's not mutual recognition. It's a respect of the system that we have here, and basically acknowledge it, respect it, and let it serve as an adequate supervisory structure to allow our guys to do business in Europe. And so it has a very meaningful response to our companies, because it's going to relieve them of obligations on reporting, relieve them of higher capital, which is required actually under Solvency II, and relieve them from some of the heavy-handed corporate governance rules that are enforced under Solvency II. So in that sense, it's very, very real and very tangible for U.S. companies.
Mm-hmm. What do you think the agreement means for the NAIC and for state regulators?
The same set of words, and we're reading them a little differently, mm-hmm. right? So we look at these words in this agreement, and while not perfect, and probably for some people not as clear as they'd like, we think that they absolutely assert respect, as we've said, for the U.S. system of group supervision and group capital. And it gives us 5 years to implement the changes on the collateral side. The NAIC has a lot of concerns with this. They've testified, we've testified. So based on what I've read and heard from talking with them, they don't think it goes far enough. I think they would have liked to have seen something that granted full equivalence. Now, that's a loaded term, and your listeners probably know that. Equivalence is a term under Solvency II, and it carries a whole set of meaning and criteria with it. And ironically, the NAIC, backed by the industry, several years ago, sent a missive over to our European counterparts and said, we don't want any part of your equivalence rules. I mean, you don't get to sit over in Europe and judge a 150-year-old state system that we've got in place over here that's tried and tested and has worked. So we're not interested in your games on equivalence. You just need to get over it and recognize us. So in our view, this agreement actually kind of does that. And while while there may be other hurdles that we need to go through down the line here, there may be other specific issues that will still require further negotiation outside of capital and group supervision. We think this takes on 3 pretty big issues and resolves them. The NAIC, I think, would rather have seen perhaps just a capitulation by them, perhaps across the board, and granted us equivalence as it's defined under Solvency II. I don't think they had any incentive to do that. Nor do I think, by the way, that they're particularly thrilled to be recognizing our system. I think that they will remain ever vigilant in trying to impose Solvency II on U.S. companies and look for constant ways to do that. But this agreement will give us a little more ammunition mm-hmm. than we have today mm-hmm. in fighting that and holding it off. And I think if, again, the NAIC, the industry has stood in lockstep with the NAIC in opposition to trying to bring Solvency II to the U.S. We don't think for a minute it will work here in the U.S. We defend and support our state system. I just wish we could see this agreement through the same lens, and maybe by the end of the day, when it's all said and done, we will get there. But
or if not today, maybe tomorrow.
Hopefully tomorrow, yes.
So the agreement certainly gives the NAIC incentive to finalize and implement its group capital calculation. Do you have any concerns about whether that will happen?
Look, there was pressure on the NAIC to look at a group capital calculation prior to this covered agreement coming to closure. So if you think back to a summer or so ago, when Congress finally resolved years later after Dodd-Frank what it meant when it put certain insurers, either structured as thrifts or those that had been designated as non-bank SIFIs under the Federal Reserve. They had also empowered the Federal Reserve to put an appropriate capital standard on those insurers. But they hadn't really defined what they meant, and there was a hearty debate about that. So Congress came back in 14, 15, I guess, late 14, and clarified through the Collins Amendment, which, again, most in the industry that were following this remember, which said, no, we actually, we know that the Federal Reserve's got to do a prudential group capital look, but it needs to do something that is unique for insurance, that respects the insurance business model. In other words, don't take that Basel bank rule and stick it on an insurance company because it doesn't work right. With that clarification, off went the Fed to design a capital agreement, a calculation, if you will, for insurers. And industry was really engaged. We were very active with the Federal Reserve in encouraging them to look at existing risk-based capital models that are already used by the NAIC in the states as the way to look at an insurance company. And in fact, you could aggregate them and calibrate them. So they come by different names. The Federal Reserve ended up embracing that for the thrifts. They called it, I think, the building blocks approach. The NAIC calls it the inventory approach, and the industry called it aggregation and calibration. So it came by the different names, but it got us to the same place. So the NAIC was already exploring this, recognizing that it was, whether it was through the FSAPs, which are an international tool, a rating and evaluation, if you will, that the international regulatory community does on all the jurisdictions. And when it came to the U.S., it kind of dinked us, if you will, when it came to group supervision and group capital, because we don't have a traditional group capital calculation and have it. So I would say that this agreement really underscores a process that was already underway. The NAIC had already undertaken an exercise to get its hands around what a group calculation might look like, recognizing that in a 50-state system, you are not going to have a real hard and fast group calculation in the same way that Europe does, because we have that 50-state, respect for the 50-state system. So this would be authority under the prudential supervisor of an insurance company, working with all the states that have some jurisdiction over that, take the aggregated RBC, calibrate it in some way, and that would be a group look, if you will. And the NAIC and industry have been very cautious to call the things like a tool. It's a calculation. It's not a standard. And I think the biggest challenge and hurdle we may have is, can we get this done in a meaningful way that can actually be a tool and not be something that goes beyond perhaps what it was originally designed to be.
Only time will tell on that front. What do you think the covered agreement means for FIO and its future?
Well, look, the first FIO director, Michael McGrath, has left with the changing of the guard and administration, so he resigned his position and has moved on. And I think he and his team there would view this as quite an accomplishment, as should this administration, just because none of us would dispute we've had a change of the guard in the White House, but it doesn't mean that the underlying work product here should be seen through a partisan lens, in our view. We think the product here, the process may have been flawed, but the product here was a good one. And so I think that this is legitimizes a role for FIO. It actually puts and clarifies in a way, in a very tangible way, why you need somebody, an office at the federal level that's empowered to look out for the international interests of this industry, because our states, as well intentioned as they are under the Constitution, are limited and they cannot do it. So I'm not sure what the NAIC, if they oppose this agreement, would actually offer us to solve the problem that I talked about at the outset, which is I've got U.S. companies right now that are my members that are being discriminated against in Europe and being required to do more than their competitors in Europe have to do, by sheer virtue of the fact that Europe won't recognize the U.S. system. This agreement would solve that, in our view. If the NAIC opposes this and this agreement doesn't happen, then what is the solution? The answer can't be that they're okay with U.S.-based companies being discriminated against in Europe, and yet their hands are a bit tied in dealing with it in a traditional international manner. Perhaps there are state-by-state MOUs we can do, but that process historically has been rather, it's certainly time-consuming and tedious, and certainly doesn't solve the problem in the most comprehensive way that we believe that this would do. So I think for the FIO, this is a real vindication for why they exist, why voices like the AIA support them existing. At the same time, recognizing, as I said also before, Title V in the statute expressly says that they are not a regulator and they have no regulatory authority. So to me, the question's been asked, it's been answered. This is what they're there to do, is agreements like this. And to me, it's a great opportunity for the FIO and the NAIC to maybe hit a restart, not to use a tired international phrase, but it may be a real opportunity to kind of restart that relationship and use it as the model for how there's a certain interdependence that could be healthy, and ironically be a validation also of the state-based system.
Let's talk about that interdependence. So some proponents of state regulation would prefer to do away with FIO.
Right.
Do you think it's possible that FIO actually makes state regulation better, stronger, more responsive?
Politics would suggest that that's going to be hard, but it absolutely should be the right goal. It's the right mission, and we testified to this several years ago on FIO. There has been a hearty debate in this industry for decades about federal versus state. That question really got answered. It's not on the table. No one's talking about federal regulation, and that's not just because of November. That hasn't been a question since the financial crisis and much before that. To the extent you ever had a conversation about federal, it was about how do we keep our market competitive? How do we engage? And to the extent the 50-state system becomes a liability to that, how do we deal with that? That's what was driving any discussions to begin with, were competition, level playing field, speed to market, things that make our market attractive, make our market effective. So now that you have this relationship with the FIO, I do believe that if the right people were at the NAIC and at FIO, and quite frankly within industry, because we have an obligation not to bait these two against each other. We have an obligation, I think, to create a very workable, effective, most importantly, effective regulatory structure for this industry. And so they absolutely should work together. And this, again, could be the model where we say, this is what you do. You, FIO, do international because that's where we're limited. But you must have us at the table. And let me just pivot on that for a second, Scott, and say that AIA has been advocating, if we ever get around to reforming Dodd-Frank, which Congress wants to do, but it's got a lot of things in the queue right now, we'd actually like to modify some language in that statute, in Title V, in Dodd-Frank now, around the FIO, and require them by statute to actually have a more official line of communication with state regulators. Because I think there is room for criticism that the FIO kind of maybe goes off too much on its own or is too insular from state regulators. So let's maybe not rely totally on voluntary goodwill, although I hope there's a lot of that. But maybe what we also need to think about is there some statutory language that we can modify Dodd-Frank, and particularly the FIO mandate, to require consultation of a core group of regulators on behalf of the states, because that is where the wisdom, the experience, and the knowledge in state regulation resides. And then that's informing the federal government, which again, we've all advocated that the FIO needed to exist for this international role, as well as for providing some level of expertise at the federal level. 9/11 happened. There was no one in Washington who understood what could be the reaction of the industry. I got calls saying, "Oh my God, are you going to invoke the war exclusion?" I mean, there was no knowledge. What if we had an office here working hand in glove with industry and by statute was required to deal with states, and there'd be that, I hope, a base of knowledge and some expertise that the federal government could turn to. So I think there's a real, for all the reasons we supported FIO initially, we're still hearty supporters of them, recognizing that there's always room for improving, and they need to, we would argue that there needs to be a heartier, perhaps statutory recognition of a role for the states working with the FIO. But we absolutely ought to figure out, and the industry ought to be a voice of reason, trying to encourage these two powerhouses to come together for the benefit of the industry.
Got it. Well, let's talk about Dodd-Frank more broadly, because it may well be reopened later this year. Are there specific changes in addition to the one you've already talked about on the FIO front that you'd like to see?
I think there's always room for for some further clarity. So I know that the insurance industry would align itself with the broader financial services community on things like how do we look at non-bank SIFI designations generally. I think there's a pretty unanimous chorus in the industry, no dispute that we never thought we were systemically risky, and if we have an opportunity to make that official and delete that whole category, then let's do it. And so I think that we'll be very engaged in sort of that Title I exercise there, if you will. I think in Title II, where you're looking at resolution, we feel like we had a really workable outcome in the original Dodd-Frank. There was a lot of recognition of the state resolution mechanism, guarantee fund role, and the role of state regulators. To the extent that needs to be enhanced, we certainly have some ideas there. The Consumer Protection Bureau, if that becomes a commission, and we would favor a lot of those kind of broader reforms that, again, the broader financial services community is rallying behind. In the meantime, we got some good language. We worked closely with the Congress at the time CFPB was drafted, but as we all know, they can have mission creep like any other good federal bureaucracy can. And so we want to really watch is make sure that they're not creeping into insurance products that might be associated with credit transactions, whether that's mortgage insurance or other forms of credit insurance. And so we've walled that off. We've fought it, but I think we've got some ideas on belt and suspenders there. We've been talking to offices on the Hill that want to put that language in there. So there's obviously a little bit of a play at CFPB. I think in that whole corporate governance, SEC oversight package, insurers aligned with some of the broader businesses want to look at some of those corporate governance provisions. At Title V, we talked about, and there's a lot of room inside Title V to do a few more things. So, I think we will have our list. We've been walking around the halls and hope that when they get through with healthcare, tax reform, and NFIP, the flood reform program, we're there with lots of ideas on Dodd-Frank too.
Good to know. Let's shift gears just for a minute and talk about the international arena. Following President Trump's election, has his victory caused you to rethink your organization's level of engagement in international matters, either at the IIS or at the Financial Stability Board or any other venue for that matter?
I think we have to remain ever vigilant. So I don't know that it's any more or less as a result of the election. I think there's some opportunities, ironically. I think there's understandably a lot of concern with sort of what people interpreted the rhetoric to mean. And are we blowing up everything? Are we anti-trade? Are we isolationists? What does this mean? And I think the early signals are that that's not what this administration meant at all. So I think we'll learn a lot through this NAFTA process. But what the administration has talked a lot about is enforcing existing trade deals. And I think that's something on the services side where the insurance fits in that's been very much of interest to us. So where we already have agreements, are we holding counterparties accountable? Are we enforcing the terms of those agreements to begin with? So I think we would welcome sort of that review of existing deals in the service arena. Where do they need to be strengthened? Where do they need to be enforced? We think that could be very helpful. And I think having a strong hand for the U.S. means in the broader trade deals, puts the burden on insurers to figure out how we're going to do that for insurers. Because as we all know, at the FSB, to your question, that's the Treasury Department, it's the SEC, and it's the Federal Reserve. But it isn't insurance.
Right.
And we stipulated already that the Treasury Department is not an insurance regulator. By statute, it says you can't. The FIO is not. SEC isn't, except where it has oversight of insurance holding companies, of course. And then we've had the Federal Reserve. Now, if the Federal Reserve's role changes dramatically, which it might if we de-SIFI non-banks, presumably they'll still have thrifts, but those tend to be largely U.S. companies. So in that international realm, we may even, I don't want to say lose because it's for all the right reasons, but we may have a less informed Federal Reserve on insurance matters. So as we have to engage at the international level, and I think this market's not changing. It has been global. It will continue to be very global for us. We're going to need to continue that investment, whether it's through FIO and this administration more broadly, and USTR and Commerce Department and all the players that inform that process. I think the burden is going to be increased perhaps on us to stay engaged because we really don't have a clear advocate in those international fora for insurance and beyond our state regulators, and we're going to need to stay at the table. Maybe not so much because there's impending negotiations, but just to kind of draw the line and hold the line on some things. I mean, the U.S. has sent very clear signals about our view of, global group capital standards, for example, common framework, ComFrame. We've got strong views on that, and we need some muscle behind it, and the industry's but a part of that. And our state regulators have a voice, but we need to stay vigilant in that. So whether that's changed dramatically by Trump, I'm not sure. I think some of the things they're saying are going to be really helpful on the enforcement side, as I mentioned. So let's enforce deals we already have in place. I think to the extent there's going to be rigor on the future agreements that are made, I think we're in a good we're in a good position to inform their thinking on insurance matters, but I think we absolutely have to stay at the table. I don't think that there's a retrenchment. I don't think there's an isolationism here. I think we are absolutely going to continue in a robust discussions of the global marketplace, and the goal here really is to double down on asserting the U.S. voice at those global tables. Really.
Got it. Well, we have just a couple more minutes for a last question. We've covered an awful lot of ground already. Are there other issues that are at the top of your members list, things that you worry about when you go to bed?
That's a great question. So I sort of have two answers. I'll try not to go on too long. So I think on a concern side, one's more concerned and one's more optimistic, right? So the concern side is this industry is a bit challenged. We're rather on the property casualty side. We can be a bit fragmented. We've got a long history. There's about 3,000 carriers just in the U.S. We're really small. We're really big. We're very commercial. We're personal lines. We're stock. We're mutual. We've got a lot of diverse opinion, and it's all incredibly valuable. It's a rich texture, and it's great. But sometimes we just feel like a Tower of Babel sometimes, or Babel, whatever the right word pronunciation is, where we're just all yapping, and I really think we do ourselves a disservice. And one thing I know, I'm talking a lot about, and my board is talking to me a lot about, is really let's do what it takes to be a part of trying to encourage and enhance a more unified voice for this industry. We've got really big challenges ahead of us as an industry, both inside the four corners of the U.S. as well as globally, and we're going to be much better positioned to advocate within our regulatory regime, domestically as well as globally, if we can learn to do that as a more unified voice. And so I think that's a real challenge for us, and we're going to have to kind of figure that out. And that means checking some egos and turfs at the door, and that's hard, right? But hopefully we're going to be a voice of pushing the industry towards that, because I think that's a real challenge. On the optimistic side, look, as much as we've all lamented a rather slow economic recovery after our recession, and that continues to be rather slow, but moving in the right direction, we've had this incredible pace of innovation that we all read about, if not participate in, by wearing it on our arm or carrying it in our hands or using it in our homes or driving it on the road or driving us perhaps more accurately in the future on automated vehicles, et cetera. We've got a ton of technology, and this industry is going to really have to get serious about how it's going to respond to that need. I had a board member, Mike McGavick, the CEO of XL Catlin, who about 5 years ago said this industry better be careful or it's not going to be relevant. I'm paraphrasing, but he talked about the relevance of the industry vis-a-vis development and innovation. And here we are 5 years later from his quote, and we are, I think, still challenged by that. And so I think one of the opportunities for us is we've got great growth potential as this industry can respond, and I have every confidence it will, to the needs of our society as it moves forward. But we're going to have to modernize ourselves, and that means bringing our regulatory brethren with us as an industry. How do we work our way through this together? Are we doing this in sandboxes? I don't care what we call them. I don't want to have too many cats in that sandbox, if you know what I mean, but I want to have some, but we have a lot of positive conversations starting with regulators who I think want to be relevant too, right? I mean, we don't want to have less regulated competitors, if you will, from outside our disruptors, if you will, coming in and creating alternative risk transfer mechanisms. Sure. That compete against us. Our system ought to be ready to modernize and move with that. So I think I'm optimistic, but it'll be a challenge for us to kind of pull a 150-year-old industry. Well, the industry's older than that, obviously 300 years old, but our apparatus here in the U.S., bring the industry and our regulators along to modernize so that we can really be positioned to respond to consumers and provide them and be relevant and provide them the products they need. So it'll be exciting. Nothing's going to be boring the next couple of years.
Leanne, thank you so much for appearing on the show. We hope that you will come back real soon. And thank you all for listening. Be sure to check out fagrebd.com to listen to other podcasts and access our great content. This is Scott Kosnoff. So long, everybody.